If the stock market crashed tomorrow, would you be able to sleep at night? If your answer is no, you're probably not investing in the kind of companies that I'm about to show you. These 5 dividend stocks aren't just stable, they've survived recessions, lawsuits, and market chaos while still paying and raising dividends for investors year after year. And today I'm breaking down exactly why I trust them with my own life savings. So let's kick things off with a company that's basically the gold standard for reliability, which is Johnson & Johnson. You probably know them from Band-Aids and Tylenol, or maybe even your last doctor's visit. But what makes J&J really special for investors isn't just their household brands, it's their consistency and the ability to keep growing through just about anything. Now, before we dive into some numbers, here's what you need to know if you're new to dividend investing. So when people talk about dividend yield, they're talking about how much cash you'd get back each year for every dollar that you invest in the stock. All right, so for example, if J&J, they pay out $5.20 in dividends per share over a year, and the stock price is $160, your dividend yield would be $5.20 divided by $160, or about 3.25%. Now this yield, it gives you a quick way to compare how much income you're getting from different stocks, which is kind of like comparing interest rates on different savings accounts. But yield isn't the only thing that matters here. You also want to know if those payments are safe and likely to keep coming. That's where what they call the dividend payout ratio comes in. And it shows what percentage of the company's profits are being paid out as dividends. So J&J's payout ratio is around 55%, which means that they're sharing profits with shareholders, but still keeping enough to invest in new medicines and technology. Now this balance is key to keeping those dividends growing for the long haul. Speaking of growth, Johnson & Johnson just raised its quarterly dividend from $1.24 to $1.30 per share, which is a 4.8% increase. That marks an incredible 63 years in a row of dividend hikes.
To put that in perspective, they've raised their dividend every single year since before man landed on the moon.
That sounds a lot cooler than 63 years, so let's just go with that. But dividends aside, is Johnson & Johnson a good company to invest in otherwise? Well, the company was just named to Fortune's list of America's most innovative companies, and their latest earnings report showed sales growth of 2.4% to $21.9 billion in the first quarter of this year. What's driving that? Well, it's not just Band-Aids and baby shampoo, which is what I thought it was. It's actually cutting-edge medicines for cancer and mental health. For example, they have a cancer drug that saw sales jump 20% year over year, and they just added a new schizophrenia medication to their lineup through a big acquisition as well. So yeah, J&J goes far beyond consumer goods nowadays. Of course, even the best companies like J&J, they face challenges. So their profits are feeling a little pressure from new tariffs on medical supplies, and they're having some more competition from generic drugs as patents expire. But here's the thing, J&J has been through recessions, lawsuits, and all kinds of market drama, and they've always found a way to keep growing and rewarding shareholders. So I doubt any of this pressure will break them. So what's the main takeaway here? Well, Johnson & Johnson is the kind of company that you could trust with a portion of your life savings, because we always have to diversify. You can't put it all in one place, duh. Because they've been proven year after year, decade after decade, that they can deliver steady growth, reliable dividends, and keep adapting to whatever the world throws at them. And with all the new innovations and rock solid balance sheet, they're not slowing down anytime soon, right? But healthcare isn't the only place to find this kind of long-term strength. So next up, we're actually diving into a company that's behind some of the most iconic brands in your home, and their dividend story is actually just as powerful. From Tide and Pampers to Gillette and Crest, P&G's brands are everywhere. But what really sets them apart for investors is how steady they've been, even when the world gets completely unpredictable. But here's the big story for P&G right now. Despite inflation and supply chain issues still making headlines, P&G managed to grow sales and keep shelves stocked. In their most recent earnings, they reported a 1% increase in net sales for their quarter, proving that they can handle tough conditions and still come out ahead. Now, when it comes to rewarding investors, P&G they're a rarity. They've raised their dividend for 68 straight years, and the current dividend yield is about 2.5%. That means that for every $100 that you invest, you'll get $2.50 back each year just for holding the stock. Now, their payout ratio, it sits around 65%, which shows that they're generous with shareholders, but still reinvesting enough to keep those brands fresh and competitive. Of course, though, there are always risks, and P&G, they face stiff competition from store brands and new players, and global shutdowns could put pressure on sales. But people, they just don't stop buying essentials like toothpaste and laundry detergent in any economic downturn. That's the kind of reliability that you want if you're looking long term. But what if you want to own a piece of the financial world itself? Well, up next, we'll look at a company that's absolutely crucial to Wall Street, and its dividend record is just as impressive. Ever wonder who's behind the scenes making Wall Street tick? Well, S&P Global is one of those companies you might not think about every day, but their influence is everywhere.
They're the folks providing the credit ratings, financial data, and benchmarks that help investors, banks, and even governments make big decisions.
Exactly, Tiara. So for instance, if you've ever heard of the S&P 500, which you better if you're subscribed to this channel, then you've seen their work in action. Now, by the way, that was kind of my hint to hit subscribe right now if you haven't. So make sure you do. But what's making S&P Global stand out in 2025? Well, for starters, the company just reported an 8% jump in total revenue for the first quarter, with subscription product sales up 7%. Now that's impressive growth, especially when you consider how uncertain the financial markets have been lately. Even more, their earnings per share climbed 9% and profit margins expanded over the last year. These aren't just good numbers, they really show a business that keeps getting stronger even when the economy throws curveballs. S&P Global is also making moves to stay focused and nimble. Plus, the company returned over $900 million to investors in the first quarter alone through dividends and stock buybacks, which is a real commitment to rewarding their shareholders. Now, on the dividend front, S&P Global is a true dividend aristocrat. They've increased their dividend every year for more than 50 years. In January 2025, they raised their quarterly dividend by 5.5%, up to 96 cents per share, which makes their annual payout $3.84 per share. The current dividend yield is around 0.9%, which is not huge, but remember, this is a company focused on steady growth and consistent returns. Now, their payout ratio, it is conservative, which means that they're not stretching to pay those dividends, and their free cash flow easily covers the payments. Now, of course, S&P Global isn't totally immune to market ups and downs. They've seen some slowdowns in mergers and acquisitions, and there's been a dip in high-yield bond issuance, which could impact their ratings business in the short term. But with their essential role in global finance and their track record of adapting and growing, S&P Global looks built to last, in my opinion. Now, if you want a piece of the financial world that keeps the gears running no matter what, S&P Global is a name that you can really trust for the long haul. Now, next here, let's look at a company powering the industrial world in ways most people never even notice. Ever wonder how factories, hospitals, and even your local craft brewery keep things running smoothly behind the scenes? Well, the answer is often industrial gases, and Linde is a global heavyweight in this space. Now, you might not see their logo every day. You may not even know how to pronounce their name, which is questionable. But their products are everywhere, powering everything from clean energy, projects to life-saving medical equipment. Linde is having a standout year in 2025. The company recently reported strong financial results, with revenue and profits both climbing thanks to growth in its core industrial gas business and a surge in demand for clean hydrogen. Now, as more industries focus on sustainability, Linde's expertise in green hydrogen and carbon capture is putting them front and center in the global energy transition.
Also worth noting, clean hydrogen is expected to be a $500 billion plus market by 2050. Their early positioning could be a big long-term edge.
Yeah, it could be a massive market. But what makes Linde a dividend stock that you can trust? Well, for starters, they've increased their dividend for 31 consecutive years, showing a long-term commitment to rewarding their shareholders. Now, in 2025, Linde raised its quarterly dividend to $1.39 per share, which brings their annual payout to $5.56 per share. The current dividend yield is about 1.3%, which is not the highest, but remember, this is a company that's all about that steady, slow, reliable growth. Their payout ratio is around 45%, meaning that there's plenty of room to keep those payments growing as profits rise. And with strong free cash flow, those dividends are very well covered. Of course, no stock is risk-free, right? So Linde, they face challenges from rising energy costs and global economic slowdowns as well, which could impact some of their industrial customers. But their focus on long-term contracts and critical industries really makes their business model surprisingly resilient. So if you're looking for a stock that's, quietly powering most of the modern world, frankly, and it's positioned to benefit from a shift to cleaner energy, Linde is a name that's worth knowing. Next, we'll check out a company that's leading the charge in America's clean energy revolution, and its dividend story is just as compelling as well. What if you could invest in the future of energy and still get paid along the way? Well, that's the promise of NextEra Energy, which is a company that's not just keeping the lights on for millions of Americans, but also helping lead the charge into clean energy. Now, if you've ever wondered who's behind those massive wind farms or solar arrays that are popping up across the country, we have one here in Nevada that I've seen many times. There's a good chance that it's NextEra. And here's why they're making headlines in 2025. So the company just reported strong first quarter earnings driven by continued growth in both its traditional utility business and its renewable energy projects. Even with all the talk about higher interest rates and regulatory hurdles, NextEra managed to increase its adjusted earnings per share and reaffirmed its guidance for the rest of the year, which is actually a big deal right now when many companies, if you're aware, are pulling back or lowering their forecasts due to all the tariffs going around. NextEra's dividend story is actually just as impressive. So the company has raised its dividend for 29 years straight, showing a real commitment to shareholders. And in 2025, the annual dividend is $2.06 per share, and the current yield is right about 2.7%. The payout ratio sits at about 60%, which is a healthy spot for a utility company balancing growth and shareholder rewards. And with strong free cash flow from both regulated, utility operations and renewables, those dividends, they look well supported as well. Now, in terms of challenges, NextEra, they face pressure from rising costs for building new solar and wind projects, of course, and changes in government policy that could affect incentives for their renewables. But here's the thing. America's push for cleaner energy, it isn't slowing down. It's not going to stop. And NextEra's scale and experience, it gives it a major edge over the smaller competitors. Now, if you don't like my list here, or you just want to check if one of your favorite stocks belongs on your own list of high quality dividend stocks, I wanted to cover what you should look for before you make any choices. All right, so the best dividend stocks are typically the big established names that have steady profits and want to reward loyal investors. That's like the biggest thing. Companies like those above, those are classic examples, right? They send out regular dividend payments to shareholders, and they have done that for years. And oftentimes they've increased their dividend payments. And while a lot of people get excited about fast-growing tech stocks, dividend stocks are all about stability and consistency. So even when the market gets rocky, those dividend payments, they'll keep coming in, right? Which gives you a steady stream of income. And the next thing they have, investor trust. If you're thinking about putting your life savings or a portion of it into the market, you want companies that have a proven track record, not just any business that happens to, pay a good dividend. That's where dividend aristocrats come in. Now, I covered everything that you need to know about these actually in my last video, but these are the elite S&P 500 companies that have increased their dividends every single year for at least 25 years. So imagine sticking with something through recessions, market crashes, and all the ups and downs for a quarter of a century. That's commitment. So why does this matter for you? Because dividend aristocrats have shown that they can weather tough times and still reward investors. They're usually in industries that people rely on no matter what, like healthcare, consumer goods, utilities, things like that. They're steady, they have rising payouts that can help fight the inflation that happens, and they provide reliable income and even smooth out the wild swings of the market over time. In fact, over the long haul, dividend aristocrats have outperformed the broader market on a risk-adjusted basis, which is kind of crazy. Now, they've outperformed the market and stayed strong through a ton of chaos, but how exactly do dividend aristocrats keep doing it? Well, click right here to see why dividend aristocrats keep making people rich to find out the surprising secrets behind their long-term success.